In January of 2026, BlackRock CEO Larry Fink wrote a letter to CEOs. He compared what's happening in tokenization to the internet in 1996. Amazon had sold $16 million worth of books and nobody understood what was coming. And that comparison keeps coming back to me because in 1996, most investors looked at the websites, but almost nobody looked at the infrastructure underneath, the servers, the protocols, the pipes that moved data. The ones who did, those are the investments that people still talk about 30 years later. The same thing is happening right now. BlackRock's tokenized money market fund BUIDL just crossed $1.9 billion. Franklin Templeton just used their own tokenized fund for an acquisition. And while everyone is watching the assets, almost nobody is asking what infrastructure are those assets actually settling on. I had to ask this myself about my own portfolio, and the answer changed how I am positioned. That's what this episode is all about. I'm Cito, welcome to episode 4 of Trillions, your RWA tokenization show, and this is the final episode of season 1. Quick context on the previous episode. In episode 1, we talked about the scale. Trillions in bonds, real estate, and funds are moving on chain. In episode 2, we then followed the fees, real compounding margins at every layer of the infrastructure stack. In the last episode, we then introduced the 4 filters that will kill most crypto tokenization projects before they see any institutional money moving onto their chain. Today is payoff. Where does structural value actually land, and are you positioned accordingly? The regulation almost no one is trading. There's a piece of regulation moving through the US Senate right now that almost nobody in crypto is paying close attention to. I think it's the single most important catalyst for the crypto market in 2026. The Genius Act, which is the first US federal law giving stablecoins a clear legal framework, has already passed. That was step 1. Step 2 is the Digital Asset Clarity Act. And that is very important because it classifies most digital assets as commodities under the CFTC. That's the Commodity Futures Trading Commission, which is a US body that regulates derivatives markets. And here's why that matters and could be a huge unlock for the digital asset industry. Right now, there are pension funds, insurance companies, sovereign wealth funds that are sitting on billions, and they all want tokenized exposure, but their legal mandates say we cannot deploy without a clear regulatory classification. The passing of the Clarity Act would unlock those mandates. And when that capital gets green light, it doesn't just trickle in, it floods the market. Just think about what happened in January 2024 with the Bitcoin ETFs. That was just one asset and one wrapper, but it triggered an entire rally, and the Clarity Act could be the key for the entire ecosystem. So the money is coming. The question that leads to the real insight, however, is what does that money need from the infrastructure it lands on? The ceiling on Ethereum and Solana. I'm not bearish on Ethereum. I'm not bearish on Solana neither. Both are winning. BlackRock is already on Ethereum. PayPal is issuing stables on Solana. That's real validation. But what I'm saying is more specific. These chains were designed to be maximally open and permissionless, and that is great and truly aligned with the original values of what this industry is built on. Anyone can send any token to any wallet, and it's a real superpower for DeFi to thrive. But for a regulated fund manager, that creates a real problem. And to make that point more clear, here's an analogy. Imagine a building where only authorized people can enter certain rooms. Approach 1 would be to hire a security guard at the front door. He checks IDs, follows a list, and that works usually. However, the guard can be distracted and someone can find a side entrance to sneak in. Approach 2 would be to design the door itself that it would be physically impossible to open the door unless the credentials check out. No person checking, the lock is the enforcement. There is no side entrance and no way to sneak in. And that's the difference between open permissionless chains like Ethereum and Solana, off-chain systems enforcing the rules while the token can technically go anywhere. For a regulated institution managing other people's money, that risk matters. When something goes wrong, that's the ceiling. So what does infrastructure built without that ceiling actually looks like? 4 decisions that define institutional infrastructure. Dedicated blockchains purpose-built for that exact moment. Not adapted from another chain, but customized for regulated institutional capital. And those 4 design decisions make the difference. Decision 1. Compliance is architecture, not paperwork. When a tokenized asset is created, the rules for who can hold it, which wallets, which jurisdictions, what qualifications are written into the asset itself. When someone tries to transfer the token, the chain itself checks out the rules before processing. If the receiving wallet doesn't meet that criteria, the transaction is rejected. Not by a smart contract on top, but by the chain itself. The token literally cannot settle with a non-compliant wallet. For a compliance officer at a pension fund, that means everything. Not hoping that the system works, but knowing that the protocol enforces the rules. And that's what's called protocol level compliance. Decision 2, you can actually see who runs the network. On most chains, the people processing your transactions, validators, are anonymous or at least not compliant or regulated by anyone. And that's by design in permissionless crypto. But if you're a pension fund putting retirement money on chain, your risk committee will ask you who is running this, and if something goes wrong, who is held accountable. On purpose-built networks, like our partners at ZigChain that have made this show possible, every validator is a known entity. They're licensed, they're held accountable under law, and a risk committee could evaluate them like they're evaluating a custodian. And this entirely changes the conversation from "we hope this works" to "we've done our due diligence." ZigChain's architecture is fundamentally aligned with the 4 layers we've described in episode 2. And we also gained a lot of great insights from co-founder and CEO Abdul Rafai, who explained in detail on how tokenization actually works underneath and who monetizes at which layer of the stack. Governance that won't pull the rug. Nobody talks about this one, but for institutions, it might actually be the most important part. When a fund manager launches a tokenized product on a blockchain, they're making a legal commitment that might last 20 years. If governance token holders vote to change a fundamental rule, the legal structure of that fund could be invalidated. For DeFi, fast governance is a feature. For a pension fund, governance instability is a fundamental risk. That's why governance in an asset tokenization context needs to be designed for institutional confidence. For example, transparent upgrade path, clear set parameters, the kind of stability that you can put into a legal framework and opinion. Decision 4, connected to everything, compromised on nothing. Tokenized assets need to connect to custody providers, to exchanges, settlement networks, but they can't lose compliance properties in that process. How that looks like in production is what ZigChain is doing by integrating IBC, the Inter-Blockchain Communication Protocol, which is the most battle-tested interoperability protocol for moving assets between blockchains. Think of it as a secure bridge with a passport check. Your assets travel, but the compliance rules travel with them. Those 4 decisions: protocol-level compliance, known validators, stable governance, secure connectivity, that's what institutional infrastructure actually looks like. Not a marketing phase, but a specific set of design choices. The proof it's already working today. DeFi Primitive is one of the first projects to launch a private credit product on top of sovereign blockchain rails. It offers up to 13.5% yield in USDC, no farming rewards, no token emissions, just real yield on a real asset. It also hit $1 million in total value locked within 1 hour after it went live. That's real products moving on chain and institutional demand validating that product market fit. And institutional capital moving on chain is not a pitch deck. Apex, the world's largest independent fund administrator overseeing 4.2 trillion US dollars in assets, is also launching on ZigChain.
With Apex, what we are providing is that anyone in the world who want to create tokenized funds, we are partnered now with the best and the biggest fund administrator in the world who can be the fund administrator for those tokenized funds. Now, that means that we can target a $120 trillion fund market, and it is happening already. So between ourselves and Apex, we are doing a 2-sided transactions where we are introducing them to the origination capabilities that are converted into the funds, and they are also introducing us to the funds who are doing the part 2s and part 3s on chain.
This is the real thing arriving in real time. The pattern most investors are missing. BlackRock bought UNI, not the Uniswap app, not a stake in the company. They bought the native token of the protocol where they're deploying on.
And essentially what's starting to happen is that more and more these institutions, they try and secure the network that on which they are running the funds, right? In the case of BlackRock buying UNI, same thing you can expect that soon a lot of these funds and these fund managers will start buying different blockchain tokens so that they can secure these networks by running the right validators and have participation rights into the governance and everything. That is where the demand can come in, number one. And number two, as I mentioned, that when you have more tokenized structures happening on your chain, both in terms of the volume and in terms of governance, the token activity gets impacted directly.
Institutions deploy on a network, they acquire the native token for infrastructure security, validators, governance. That is not pure speculation anymore. That is actually structural behavior as institutions are entering the digital asset economy. More funds moving on chain means more transactions. More transactions means more fee demand for the native token. That compounds, and every fund settlement, every distribution payment, every compliance validated transfer generates demand for the native token at institutional volumes. The thesis isn't token goes up because the market is bullish. It's that the token now has protocol level demand tied to the real world financial activity on chain. And that is a fundamentally different kind of positioning. And it's the one that almost no one is talking about. What am I doing about this? I used to think purely on the asset layer, but it's like scratching on the surface. But now I'm asking a different question. Am I at the right layer where the structural value actually accrues? So there's three things I'm watching. One, the regulatory calendar and not the Bitcoin halving cycle. The Clarity Act here is a real trigger. Two, which infrastructure the money actually lands on and not which asset gets tokenized. Three, and most importantly, proof of real demand. Not MOUs, no partnership announcements, but actual capital arriving. So I'm not telling you what to buy. I'm just sharing with you how I'm thinking about it. And I wish someone had laid out this framework for me earlier. Now, let me leave you with this. In 1996, everyone watched the websites. But Cisco, the company that built the routers and switches that actually moved the data, became the most valuable company on earth. Not because they had the best websites, because they were the best layer the entire internet can run on. I'm not saying that ZigChain is Cisco here. I'm saying that the pattern is the same. The tokenized funds, the BUIDL inflows, the ETF approvals, those are the websites. The infrastructure those assets settle on is the layer underneath. And throughout the history of technology transitions, the infrastructure layer is where structural value accrues. This has been season 1 of Trillions, 4 episodes, 1 thesis. Institutional capital is arriving, the regulation is clearing the path. The only question is whether you're watching the right layer. And if this season changed how you think about asset tokenization and RWAs, then please share it with someone that you think needs to hear this. The full playlist about everything we've covered is linked below. See you in the next one. Stay safe and be good.